All right, great. Thank you for joining. My name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. And today we're going to talk about investing myths. Well, one particular myth. This time it's different. So we'll get into that in a second. But first, we have to go through all our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. But I would like questions. So if you have any questions, send them through at any time. So you can send them through that Q&A button at the bottom of the screen or through the chat. The other thing, the question we normally get is, will a replay be available? And the answer is yes. So we are recording this. Will's recording it. Now Will puts all the videos on YouTube. So we have a YouTube channel. So you can go to the YouTube channel and see all the videos. If you need a link, just send me an email at mark.lamonica1 at morningstar.com. I'll send you the link, and then all of them go up there, and they also all go up on our website as well. So with that aside, we can get into it. And I think I reminded Will again to record this for YouTube. He has to press a different button on his camera. Okay, getting already some weird comments, but they're from people I know. Okay, so let's get into this. All right, so as I said, investing myths. So we're going to do a single myth this time, and it is, this time is different. So let's start getting into this, and we'll explain what that means, or I'll explain what it means. You know, there are people in the room. I am the only one you can see. All right, so today we are going to look at old white men and things that they say about the market. So as I get called an old white man by my whole team, so I'll be the fourth one, but we're going to go through three in here. So this is the quote that we're going off of this. So of course, Sir John Templeton, a very famous investor, says the four most dangerous words in investing are, this time is different. And we've heard a lot of that recently. We are in what many people, myself included, think is a bubble right now in all sorts of different things. And that's the quote that we always hear at the top of bubbles, that this time is different. So things like valuations don't matter, and the market will just continue to go up forever, apparently. But that's the point that Sir John Templeton's trying to make here, and that's what we're going to explore today. All right, so old white man number two is Joseph Kennedy in the middle there. So he, of course, is JFK's father, who we can see sitting next to him. Then that's his other brother, also named Joseph, who died in World War II. He was the original Kennedy that Joseph Sr. was going to try to make president. So we're going to talk about a lot of different measures today around the market. But there's this famous quote, and there's no way this actually happened. There's this famous quote from Joseph Kennedy and the story is that right before the Great Depression, so right before the stock market crash in 1929, he's getting his shoes shined, and the boy that's shining his shoes is giving him stock market tips. And Joe said, wow, this is a sign that we're in a giant bubble, and I'm going to go and sell all my stocks. And he did do that in real life. So he got out of the market and actually shorted the market. Then the crash happened, and that's one of the many ways he made lots of money. Now, in reality, this didn't happen, or it's very unlikely this happened. First of all, in 1929, the guy shining his shoes probably wouldn't have been able to even invest. But anyway, the point is that, and we're going to talk about this a lot today, that as you get to the top of a bubble, you start hearing about investing everywhere, and everybody's interested in it. So that I think that is certainly happening right now, and we'll get into that a little bit more. And then finally, old white man number three. So this is Jeremy Grantham, and we're going to base today, a lot of today, on Jeremy Grantham. So Jeremy Grantham, unlike old white man number 1 and 2, is still alive. So he's a money manager in Boston he's somewhat retired now, but he works for a company, he founded a company called GMO, the G standing for Grantham. And one of the things that Jeremy Grantham, and he's a classic value investor, but one of the things he has done is he's called the top of a lot of different markets. So he recently put out a piece that has been pretty widely written up, saying that we're in a bubble and it is about to break. So we'll go through a couple of things he said. So if you guys are interested in Jeremy Grantham, and I don't normally recommend you listen to any podcast but Investing Compass, but if you want to take a break, he's 4 or 5 episodes ago on Invest Like the Best. So Patrick Shaughnessy, who is a money manager from Greenwich, Connecticut, where I grew up, does that podcast, talks to a lot of interesting people, talks to Jeremy Grantham, and he walks through his thesis around why we are in a bubble. And we're going to talk about a little bit of it today, but if you want to hear directly from him, you can listen to that or just Google his article. So it's on the GMO website, and you can read what he has to say. So he says there are 3 indications that you are in a bubble. So we're going to talk about all of these today. So number 1 is valuation. So valuation is certainly a big one. Then, of course, signs that there's speculation. And finally, crazy behavior. And for those reading the paper, we've seen a lot of crazy behavior recently. But that's what we're going to talk about today. So, and I think, one of the things that Grantham starts out talking about, which I do think is really interesting, is that he compares where we are right now as to where we were pre-COVID. So a year ago and a couple of months, so a little over a year ago. And if you remember back at that time, certainly if we looked sort of across global economies, there was really low unemployment. All the economies were doing very, very well. And yet here we are with some pretty severe economic damage and the market's higher. So I think Grantham and a lot of people are sitting there and looking at that saying, how is this actually possible? That when we had a near perfect economy, the stock market was actually lower than it is today. So not only and even as we're emerging out of COVID, I think his point is that, not only has the market priced in the COVID recovery, and we could argue that sort of last year as the market was coming back from the falls, but it's priced in a COVID recovery and now gone beyond what it was before. And there aren't many signs that the economy is actually going to get back to where we were before. So anyway, interesting stuff. But let's look at valuation first. So we've done this in a couple of these webinars and a couple podcast episodes, but it's always good to go back and look at things again. So we're going to look at a couple different valuation measures, and we're going to start with the Buffett Indicator. So what the Buffett Indicator is, and it's called the Buffett Indicator because Warren Buffett came out and said that this was what he thought was the most valuable and accurate way to look at overall market valuation levels. And so the Buffett Indicator basically takes an index. So in this case, the Wilshire 5000. So basically the Wilshire 5000 is, and there aren't 5,000 companies in it anymore, but it's looking across all different stocks in the US. So from large cap all the way down to micro cap stocks. So it's basically the entire US market, as opposed to like the S&P 500, which is just the 500 largest companies traded on US exchanges. So what this compares is the valuation level of all the stocks in the economy versus GDP. And as you can see on here, this is historical back to the 70s. So if we go back to 1970, which for those of you doing math is over 50 years, there are only 3 times that this actually broke, that the value of all the stocks exceeded GDP in the US. Excuse me, and you can do this for any country, looking at their own markets. So you can see these 3 times. This 136.9, that is the tech bubble that burst. 105, so right there, that's the GFC. And here's where we are now, 138. So yeah, both those other times that it exceeded, that the value of the stock market exceeded GDP, pretty terrible times to invest, as you can see by these giant drops afterwards that brought us way back down. So anyway, just one indicator. The other thing that we like to talk about is the Schroder PE. So the Schroder PE is also called the CAPE ratio, so it's a cyclically adjusted PE ratio. And what that basically does is it goes back, and one of our problems, so when we look at regular price to earnings ratio, we're comparing how much somebody's willing to pay for earnings. The problem is that people always think about the P, the price, so that's the general market, or if you're looking at individual stock, the stock price. We always look at that fluctuating, but the E fluctuates a lot as well. So the earnings fluctuates a lot, especially right now, right? So a lot of the P ratios, and if you look at them right now, they are really, really high, but a lot of that is because earnings dropped a lot last year. Around COVID. So they can be a little bit misleading. So what the Schroder PE or the CAPE ratio does is it goes back 10 years. So go back 10 years and look at earnings over a 10-year period. And what that does is that smooths out a lot of those earnings spikes that could bounce around. And so you can see, once again, we're going back even further. So we're going back to, 1870. Even I wasn't alive then, as old white man number 4. But if you go back and you look at this, look at some of the highs we have. So Black Tuesday, so that's right before the Great Depression. So you can think about Joe Kennedy getting his shoe shined right there. And this, of course, is the dot-com bubble in 2000. And then, of course, we've got right here the GFC. And once again, we're not as high as 2000, but we are very, very high. So the two highest figures, obviously, were 1929 and 2000. Both of those were followed by really, really bad bear markets. But yeah, just another indication of where we are from a valuation perspective. Then the last one I wanted to talk about is Morningstar. So I'm looking at the US market here. We can also have this chart for the Aussie market. But what this is looking at is what our analysts are doing is they are doing a sort of bottom-up valuation of the market. So they're looking at all the individual stocks that they cover. And they, of course, for those that are familiar with what we do here, they calculate a fair value for all of those different stocks. And then they compare that to the market price. So basically what we do is we look at a price to fair value measure. So anything that 1 means it is fairly valued. We think the share is worth $15, it's trading for $15, so it's fairly valued. Anything that is above 1, we think is overvalued. So it's trading for $30, and we think it's worth $15. So that's overvalued. Then, of course, anything less than 1 we believe is undervalued. So we just went back, what do we go back, 10 years here, and you can see undervalued and overvalued. So we are pretty high right now from an overvalued perspective. The one thing I would say is the way that we look at this is we do this equal weighted. And it's based on just the stocks we cover. So we do cover a lot of stocks globally, so over 1,600. This is, of course, just looking at the US, but it's a equal weighted look at this. So remember that markets are not equal weighted. Markets, larger companies have bigger influences on indexes because they're market capitalization weighted. So and given what's happened, sort of the run up that has happened just in a small number of stocks in the S&P 500, for example, this could, if anything, sort of distort that lower. But if you look at this, yeah, we think the US market is around, I think it's 8 to 10% overvalued, but that's looking at that's looking, of course, at equal weighted. And the other thing I would say is we do not think that necessarily being fairly valued is a good time to invest. So we always want to build in that margin of safety. So if you look at sort of our star ratings and how they translate off of valuation measures, it does take a pretty significant discount from fair value to get a 5-star rating, which is our cheapest stocks. So I think from a valuation perspective, there's really no way to look at this other than to say that the market is overvalued. That does not mean it's going to fall, of course, immediately or at any time. Now, Jeremy Grantham thinks so, and he's a lot smarter than me. But yeah, there's certainly other people who have different opinions. So let's move on to the other measures. Speculation and crazy behavior. So apologies to Will for me putting up a Bitcoin picture. So Will is our videographer. Will loves Bitcoin. So I've included in the crazy speculation behavior, but I mean, I think it's fair to say Bitcoin has gone up a lot. So I think that's an indicator, but we'll get to that in a second. So a couple other things I just threw on here. Shack SPAC. We'll talk about SPACs in a second. So that's a special purpose acquisition vehicle, and that's Shaquille O'Neal. The other thing we have on here is GameStop. So if anyone wants to talk about crazy speculative behavior, and I'll go into this stuff more, you can see a 1-year chart of GameStop. Couple spikes on here, huh? Yeah. That is definitely crazy. And then I joined this group. So I joined a bunch of these investing groups I guess, as research to see what investors in Australia are looking at. If you ever want to drive yourself crazy, join this ASX stock tips group and read some of the comments that go up there. Basically, it's this group on Facebook where we'll use the term investors very loosely on that thing. Everyone just sits there and tries to pump up their own positions and put little rocket ships after all of these minute stocks that they think are going to go up. And here's just an example that literally I just found today when I was throwing together this presentation. If you don't, I'll read it to you. If you don't know, now, well, this is not very punctuated very well. If you don't know, now you do. I'm assuming we're looking for a comma in there. A potential double or triple your money by the end of the month. And in 3 months, I don't even know what that emoji is, but I assume that you're then a billionaire. So this is the kind of behavior that's going on right now, and it's very speculative. And a lot of this stuff was pointed out by Grantham in his article. So a couple of things that he talked about. And we'll start talking about these SPACs. So in 2020, so what happens at market tops is, of course, companies rush to go public because valuation levels are so high. From a company perspective, it's certainly smart, right? They're trying to raise money through equity markets. So you see a bunch of companies going public. Same thing that we saw back in 2000. And that was when all these things like pets.com came up, where we just put .com at the end of everything. And all of a sudden, everyone bought it. But we'll talk about that more in the future. But anyway, 480 IPOs came out in 2020. And that was actually more. This is in the US. 480 IPOs. So that was more than the previous peak, which was in 2000, which was 406. Now, of those 480 IPOs, 248 of them were SPACs. Now, we'll talk a little bit about SPACs because they're crazy and certainly an indication that the market might be extremely overvalued. And we're doing a podcast episode on SPACs. So we'll release that on Sunday. We're going to record it after this with our fancy new microphones. But a SPAC, a special purpose acquisition vehicle. So without spending too much time on this, you can listen to the podcast episode. Basically, a SPAC is set up as a publicly traded company that has no commercial activities. And the whole purpose of this is to set up basically a mechanism to go out and acquire, or what they call a merger, but acquire another company. And it's a way for private companies to go public without jumping through all the hoops that an IPO takes. You know, all those hoops like having a sound business and publishing financial statements and, going out and trying to convince actual investors to buy them. So these SPACs have become very, very popular. So they've been around since the 90s, but they've exploded in popularity recently. And so basically all these SPACs are going around. As an investor, if you buy into a SPAC, you're buying shares in this company that does nothing. It's basically like a shell company. So you buy shares into it, and then whoever is running the SPAC goes out and tries to find a company. So some of them are run by real investors. Some of them are fronted by celebrities, which is the Shaq SPAC. So Shaq is one of many people that are involved in these things now. And of course, the problem is that if you look back at what I was saying earlier, 480 IPOs, 248 were SPACs. So, for those of you that can do math, more than half were SPACs. So now you've got all of these SPACs going out trying to find companies to acquire, which is, of course, just driving up the prices of all these companies. And all these SPACs are actually valued at, I think, on average, 20% more than the sum of money they have to go out and buy a company. So they're expecting Shaq to go out there and find a company that actually is worth 20% more than what he's paying for it, even when there's all this competition for these companies. So some crazy stuff happening with SPACs. Listen to our podcast episode. We'll go into more detail about it. Other things that indicate that there's a lot of speculation and crazy behavior. 150 non-micro-cap companies. So that is a company that has a market capitalization. So that's shares times price, so how much the company is worth. So 150 non-micro caps, so 150 companies that are worth more than $250 million. So we're thinking like real companies here, have more than tripled in value in the last year. And that is 3 times as many as any other year in the previous decade. So this is what all these ASX stock tips people are doing with the rockets and emojis and everything else, is that all of these companies tripling in value in a year, right? Like that is very difficult to support from any sort of business fundamental perspective. The other thing that's indicating speculation, so if we look at the US, and the same thing's happening here, so the volume of small retail purchases of less than 10 options contracts, call options contracts on US equities has increased 8 times when we look at 2020 versus 2019. And 2019 was already above average. So what does that mean? It means that investing in stocks is not enough for people. People want to take option plays on them. So basically what an option is, if you buy a call option, you are rewarded if the stock goes up over your strike price. You lose all your money if it doesn't. So this is very, very speculative. And I know this is a personal story, but a friend of mine, her dad, she's an American living here in Australia, her dad is trading options on SPACs in the US, which is crazy. She knows it's crazy. Not that she watches these things. But so a lot of speculation, a lot of options are being purchased. You read about this stuff all over these message boards. And these message boards, frankly, they're very, like this ASX Stocks Tips is one here. It's very similar to some of the boards on Reddit that we've heard a lot around GameStop. So yeah, pretty interesting. The other thing that's interesting, so Robert Shiller. So if we go back, remember, we had the Schroder PE. So Robert Shiller is the economist that came up with this Schroder PE. Now I'm just all over the place. Yeah, he won a Nobel Prize, so, you know, figure he knows what he's talking about. So he's sitting there, and he called the 2000 bubble, as did Jeremy Grantham, and the 2007 bubble. He said that looking at the Cape, which suggests stocks are nearly as overpriced as 2000, he says that that's actually not the biggest bubble. The biggest bubble's in the bond market. He says that bonds are extremely overvalued as well. So we're in sort of a bad situation where stocks may be very overvalued, bonds may be overvalued. No offense, Will, but Bitcoin might be very overvalued. So there could be a lot of issues coming up for investors. And so let's talk about where we are. Oh, now I'm going the wrong way. All right, so this is a quote from Jeremy Grantham, which I liked. I think of all the old white men, including myself today, Jeremy Grantham seems to be the star. But yeah, I like this quote. So he's saying investors are relying on accommodative monetary policy, of course, and zero real rates extrapolated indefinitely. So what he's saying here is that what we've seen in the response from central banks around the world to COVID, but frankly, the things that they've been doing since the GFC and the level of interest rates, that all investors have just decided that this is going to last forever. And I like this extrapolated indefinitely, because I think it's not just, so he's talking about interest rates, but it really applies to all sorts of different things. So we've all decided that inflation's dead, interest rates are going to stay low forever, profit margins, which are almost at record highs, are going to stay forever. There's a lot of things baked into the stock market right now. And I think we've seen signs of this cracking, right? So about a month ago, when interest rates went up a little bit, the market freaked out and we saw a big sell-off, particularly around a lot of growth stocks. So I think we're starting to see signs of cracks. And what this basically means that if all of these assumptions about profit margins, about central banks, low interest rates, no inflation, if any of these assumptions actually breaks, then potentially we're in a lot of trouble. And, one of the things that I think Grantham was talking about that was really interesting is, all bubbles basically end. So I had this quote, all bubbles end with near universal acceptance that the current one will never end. So once we've gotten to this point where we all sort of accept that this will never end, that's when the bubble actually breaks. So he looked back at he looked at 29. So 1929, market commentators decided that the market was at a permanently high plateau for whatever reason. Obviously, That did not last. In 2000, so the tech bubble, so we think of the tech bubble obviously as all these obscure like things like pets.com that I was talking about, but really collectively, everyone just decided that there would be continual productivity increases from workers due to the internet, when at least everyone I work with just uses the internet to distract themselves, including me. But that's what we decided in 2000, that we would continue to see all this productivity. So Greenspan kept saying it over and over again. That did not work out too well. We look at the housing prices, right? So there's a quote from Bernanke, who was the Fed chair at the time in 2006. U.S. house prices merely reflect a strong U.S. economy. Well, that didn't work out too well, did it? So those housing prices were a little bit high. So what's happening right now? Well, right now, as I said, we are deciding that interest rates will be kept close to zero forever. We've decided as investors that central banks will continually bail us out, as they have after all of these different kind of calamities like COVID. So yeah, pretty interesting time. The one other thing I would say is, and once again, I don't know if the market's going to go up or down. I tend to agree with what Grantham's saying, and I think there's a lot of troubling signs. But don't listen to me. Maybe listen to him. Go read his stuff. One of the things that I think is interesting is, he has actually come out and said when he thinks this is going to happen, which almost nobody does, because you always hedge your bets, as I do with all of this stuff, and say, hey, market's pretty overpriced, but it was overpriced 5 years ago. It could keep going up way longer than any of us think. So he thinks it's going to happen. He's in Boston, so he's looking at Northern Hemisphere. So he said late spring, early summer. So very soon. So, if you start looking at, if you think about us, so sort of late autumn and in early winter, that's the timing that he is saying. Which I think is pretty interesting. So, and the one other thing I meant to say this earlier, if I go back to this Morningstar, graph looking at overvalued versus undervalued, the one thing I would say is that markets often overshoot whatever direction that they're going in. So they certainly do that on the downside, or they certainly do that on the upside, but they also do that on the downside. So even if all of our analyst estimates, and obviously they're very difficult to do, are completely correct, and the U.S. market is 8-9% overvalued on an equal weight basis, that doesn't mean it's going to go down 8 or 9%. These things go way, way below and overshoot the mark on the downside. And the last thing that I would say is I follow another investing board called Raise Investors Australia. So for those that don't know what it is, Raise is a micro investing site. So you go out there and you use your credit card and you buy something for $1.50 and they sweep the 50 cents into Raise. So I don't know. It's fun, I guess. But they have this investing board, which is insane, by the way. Hopefully nobody's watching from there, on Facebook as well. And once again, it's all these comments coming back. Now, Raise is invested. Raise, what it is basically you pick a different portfolio, but it's ETFs. So it's widely diversified. These are ETFs by some of the leading providers. We rate a lot of them and think very good things about a lot of these ETFs. So this is not speculation in any way. But all the people that are investing in Raise, when the market dropped, 3-4 weeks ago, I remember it went down 3%. You should have seen the panic on this board. And people were literally it was a psychology session, hang in there, you can do it. It dropped 3%. The NASDAQ went down 82% after 2000. So I don't think a lot of investors, if you are in your early 30s now, you've never seen a down market. Never. There was this drop last year that lasted 3 weeks. So you've never seen a down market. So one of the things that I'm also kind of nervous about, and a lot of people are nervous about, is unlike other bubbles, this is a retail bubble. So a lot of this has been driven by retail investors. A lot of this has been driven by by retail investors, and these are retail investors that have no experience and are going to panic. Like everyone panics. The most experienced investors panic during these slides, but I don't know. Maybe this is me being old white man number 4, but I don't think a lot of these younger investors have the stomach for this. And so I think what that's going to do is it's going to exacerbate the selling. So that's, of course, my personal opinion. I'm getting nasty messages from people in the room, which is nice. But anyway, that was my little rant about the market conditions. And one thing I will say is what this is this is a setup for Tuesday's webinar. On Tuesday, what we're going to do is we're going to go back and we're going to look specifically at some of these crashes that have happened. So when we go back and look at these different bear markets, kind of specifically, we're going to look at 2000, which I think is really interesting, and then sort of the Nifty 50 crash that happened in the early 70s. And no, I was not alive for that because those are what the messages I'm getting, because I think that has some parallels about what's happening today. And we'll try to talk about like what you can do as an investor. So this is sort of the setup. And then, yeah, on Tuesday, we can go through and talk about some of the other stuff. All right, so we have a couple questions. If you have more questions, ask them, because my weird, the market's overvalued rant only lasted 32 minutes. But okay, so we've got a question from Lisa. Once again, Lisa is the owner of 3 alpacas. I don't know if there is an alpaca bubble going on. I've not managed the price, or I've not looked at the prices of alpacas. Although the other day we looked up a website around the Australian Alpaca Association and looked at some of the prize winners. I forget there are 2 different categories. I don't remember what they were, but I'm looking at Shani in the room who was looking at the alpaca website with me. So Lisa says, what are the implications to the market of government debts being so high? Does this high debt mean governments are keen to keep a lid on interest rate? Yeah, so all right, a couple different things. So yeah, governments are certainly keen to keep a lid on interest rates, but that's really central banks that are doing it. So, central banks are supposed to be independent. And so they're making their own policy, obviously trying to support the economic growth of countries. So I think it's 2 different things. So yeah, there's a government debt thing. The government debt thing will be interesting, right? Like if governments are piling up a lot of debt, as you're all pretty aware, you just saw the US pass another enormous stimulus package, 1.9 trillion, I think, which is shockingly high, in my opinion. But yeah, governments are obviously, governments went into this with a lot of debt, and now they are racking up even more debt trying to support the economy with some of this COVID fallout. Another indication, I think, if you go back to what Grantham was saying, another indication that the economy is not right. Governments do not pass $1.9 trillion relief packages when the economy is doing well. So the economy is not doing well. So yeah, the implication of debt, I think, not to sound like, once again, an old man, but yeah, it needs to be paid back at some point. So that's going to result at some point in government either raising taxes or cutting spending, both of which are really bad for the economy. The other thing I would say, if we look at profit margins, right? So I made that comment about people are extrapolating currently very high profit margins way into the future. One of the things that could happen is taxes could be raised on companies. That erodes profit margins. Or, of course, if they're raised on people, that's probably going to erode their profit margins too, because they'll have to lower prices. So that's an example. And yeah, central banks are very keen to keep a lid on interest rates. So we saw that when interest rates went up a little bit, like the RBA, if you go back and Google and just look at what happened in the past month. The RBA, when interest rates shot up a little bit in Australia, came out and bought a ton of bonds that next Monday. So yeah, central banks are trying to keep a lid on interest rates, and they've all said that they're going to keep them low for a number of years. The question is, can inflation get to a point where all their pledges to say that, they would let inflation run a little bit, when does it run out? When do they get to the end of their tether and actually try to stop it, if it happens? All right. So we've got a comment from John. So he says, agree, markets fall, collapse from time to time, but over the longer time, markets go up. Time in the market, important over time in the market. Yes, Shani, that is your favorite saying, time in the market over time in the market. Should we pull out because it looks bad now? So we'll spend some time on Tuesday talking through that. And yeah, no, I mean, I certainly would not be an advocate for completely pulling out. I mean, I can talk about what I've been doing. I've been selling a couple things, but like more importantly, I haven't really been putting anything new in. So as I continue to save, it's been going into cash. I used to have dividend reinvestment plans on all of my accounts, so basically buying new shares when the dividend gets paid. I've stopped that a couple of years ago, so I'm personally just trying to build up cash, just because valuation levels do have a big impact on future returns. And that's one of the things as well, not to keep picking on all these message boards I follow, but you are seeing a lot of very well-meaning, I think sort of they're described as finfluencers. Did I say that correctly? But yeah, there's a lot of interest in saving and investing now, and so you're seeing a lot of Instagram accounts and Facebook groups popping up, helping people to try to save and invest. And yeah, they are using return expectations in the future, which I think I said on Tuesday, I just don't think are going to happen. So I think that is the real question. Like, what do you do with new money that you're saving and investing? So my personal decision is, I'm thinking they're going to fall. The markets are going to fall, and there's just going to be a better buying opportunity in the future. So yeah. So I've got a comment from him saying people are in denial. Yeah, I agree. All right, so I've got a question from Angus saying, I've heard that the market generally looks good 18 months ahead. Do you think the market is still looking good 18 months ahead? So I guess I'm not sure exactly where that comment came from and sort of what you mean by looking good. I think there always is this. All right, well, let's get back and look at what actually drives stock market returns. And maybe this is what you're asking, but Angus, if you want to put through some more detail, I'll see what I can do. There are three different things that drive market returns, right? So this is basic math. So returns come from either dividends that are paid to you. So that's one source of return. Returns come from company growing their earnings. So a company grows their earnings. So if we think about a valuation level, we'll just use a simple example, a price to earnings ratio of 10. So somebody's willing to pay for whatever this company is 10 times their earnings. Well, if the company grows their earnings, then of course the stock will go up because they'll use that same multiple. But then of course the big thing that we're working with here is multiples. What is somebody willing to pay for $1 of earnings? So that's the third source of return that you get as an investor. Now, what has happened over, if we go back and look at 1990, for example, and I don't have the figures in front of me, but like the Aussie market, I think was trading at like 10 times earnings, somewhere around there. It's way higher now. And so this multiple expansion has been driving a lot of the returns. You're still getting dividends, you're still getting dividend growth. Of course, companies are making more money, but if you don't have this multiple expansion, so even if nothing happens in the market, right, it doesn't fall, you just don't have a multiple expansion. In 18 months, I don't think earnings are going to grow enough to justify where the stock market is right now. Now, that's a personal opinion, but yeah, I mean, I guess something to think about. All right, we're out of questions. Look at this, with 20 minutes to go. All right, I'll show you where you can find the podcast on the website, not the podcast, the webinar. I'm very confused. Maybe that's because I'm old. What is this? Oh, that's my email. I shouldn't be showing that. What is this? This is what I'm trying to get to. Wow, I didn't see my email. Hopefully I didn't have anything crazy in there. Anyway, if you are a Morningstar Premium member or you want to take a free trial, you can go onto our Learn section. If you go to this Morningstar Investing Bootcamp, this is where we post all the videos. And then the other thing you can do, so is the market overvalued? If you're sensing a theme of these things, you probably know what I'm thinking about. But yeah, you can go and see any of the webinars on there. And also just Google Morningstar Australia YouTube. And we have a YouTube channel now. Will is very into our YouTube channel. It is certainly a better idea than when he tried to force me to get Twitter. But you can go on to that and see all the previous ones as well. Oh, now we're getting more questions. So every time I do that, more people ask questions. So I do not get to spend 20 minutes before my next terrible meeting. Not that this one's terrible. The next one, sprint commitment. Okay, so we've got the valuation indicators you're showing are all relating to the U.S. market. Do they apply to the Aussie market as well? Yeah. So I was looking at the U.S. market. They do all apply to the Aussie market. So the Aussie market's pretty overvalued as well, but that's a good point. So if anyone's interested in seeing the same stuff for Australia, send me an email. So mark.lamonica1@morningstar.com. I can send the Aussie numbers as well. So we think, so just so you guys know, if we go on to if we look at Australia, so we think Australia, once again, this is sort of bottom up analysis. We think Australia is 8% overvalued. So that's the Morningstar price to fair value for the country. So once again, that's equal weighted of everything we cover here. Just as an example, and the numbers are starting to get interesting now. As an example, a year ago, we thought the market was 6% undervalued. So think about a year ago, we'd already commenced in this COVID drop. And in a couple of weeks, I think the market, when did it bottom? Like the 23rd or the 24th of March. So we're getting close to there. So it'll be interesting just to compare these numbers. Okay, so Lisa, once again, of Alpaca fame, says, does investor jitters affect equity prices? Yeah, they do, right? So at the end of the day, I think that is the worry. So a couple interesting things. Like, as I said, a lot of this is being driven by retail investors. And so, yeah, jitters, people sell, it just exasperates the selling, right? So these things take on momentum, right? So market falls, people get scared, they sell, market falls more. So yeah, investor behavior is pretty key. And that's where my little, people have not seen a bear market. A lot of earlier investors have not seen a bear market comment came in. So yeah, I think some of these jitters do affect the market. But I think more than anything else, it's expectations, right? There's this, as I was saying about future returns, there's this expectation by a lot of people that the stock market is just going to return 10% a year no matter what. And, when you read, and yes, literally, that was the first message I saw on that ASX board Facebook group. But when you see messages like that, you start to see that, yeah, people have really high expectations for what's going to happen, double or triple your profit in a month. Yeah, that's not rational. We have lots of questions. Okay, so we've got a comment. Can you talk about the situation for older retirees? Yeah, I think obviously everybody's situation is unique, and this is where we can't offer personal advice. So what I would say is, I think we did a good job. I'm gesturing towards Shani, who's off camera. On the podcast, we did a podcast episode talking about if the market's overvalued. And we looked at investors in different time periods. So we used Shani as an example. She's like a year or two younger than me, I think. It's impolite to ask a woman her age. But yeah, I think a year or two younger than me. But what the point she was making is, yeah, she thinks the market's overvalued, but she is younger. And, if you look at the amount of money that she has invested right now versus the amount that she's going to continue to earn and invest in the future, the balance is stuff she's going to continue to earn and invest in the future. So she would be less impacted, of course, and given her time horizon, by a market fall. And if she just continues to invest, basically dollar cost averaging, but like a paycheck by paycheck investment, which I know that she does, the market falls, well, great. She's just going to continue to put money in there. Obviously, it's a very different situation if you are a retiree and you are not saving and investing anymore, and you're drawing down your portfolio. So, the thing that I would say, and kind of sort of the advice that I guess we give here at Morningstar, is, look at sort of your cash needs and your ability to weather a bear market, because markets go up and down, and that doesn't matter if you are Shani and you have a very long time horizon. It does matter if you have to sell assets to fund your life. Because then the problem is that you are selling assets when they are really, really cheap. And that's not what you want to do, right? You want to sell them when they're actually high. So that's why I would look at your cash needs and how much cash you have. Like, people hate cash, particularly now, because you are getting next to nothing on it, but cash has a lot of other uses. So I guess for people approaching retirement, or people that are in retirement, think about cash needs. So I invest my mother's money for her. She texted me before and said she wasn't going to watch today because her friend had surgery and she had to go get her from the hospital. But with my mother, I invest her money, and so we've got 5 years worth of living expenses in cash. And so the thought then is, of course, she can weather any bear market, and she won't have to sell off assets at the bottom of a bear market, which is not what you want to do. So yeah, something to think about. Yeah, so Mim's making a comment. Yeah, it's called sequencing risk. So basically what I'm describing is sequencing risk, so particularly as people are approaching retirement, that the sequencing of returns matter a lot. So if you think about it, and we talked about this the other day with the 4% rule, but yeah, if you think about, there's the average return that of course comes in, and that's the same no matter what sequence it is, but then the sequencing matters. So if you're retiring and there are huge drops in the market, right as you retire, it's a problem. So that's something to think about. Yeah, so Steve is asking a question. So he's saying, with general market overvalued, you see particular segments more or less overvalued: banks, financials, retail, mining. Okay, so it's a good question. I am, of course, not an analyst. What I would say, Steve, is what has happened is there has been growth stocks that perform very well. And so we've talked about this from just looking at tech stocks, for example. Once again, don't quote me on these numbers, but coming out of the GFC, it was something like tech stocks made up 18% of the S&P 500 in the US, for example, and now they're 28% of the index. So we've had these growth stocks doing really well. Value stocks have not done well. So in terms of value stocks, is banks and financials generally fall into the value category. So you're saying retail, mining, and mining. So yeah, mining obviously will be an interesting one. Sort of inflation. If inflation starts, what will that do to commodity prices? Generally, commodities do hold their value in an inflationary environment, as long as obviously they're still being used. So yeah, I think you should look sector by sector. Saying the market's overvalued does not mean there are not opportunities. So certainly our analysts put out a global best ideas list, which I can show you guys where that is. That's not it. We'll see if I can do this without showing my email again. Yeah, so our analysts put out a global best ideas list. This probably looks very hard, but there's all these things on my screen that I have to move around. And, as old white man number 4, it's hard for me to use a computer. All right, so here it is, Global Equity Best Ideas. So every month they come up with a list. There's 72. That's exactly what they say it is, 72 stocks from around the world. So you can see the Aussie ones are on top. So yeah, there are certainly opportunities. And I will say the other thing that's happened with the market is because tech stocks, and in particular, a couple of the companies that are in the news all the time, so Apple, Netflix, Telstra, Amazon, like the returns in the market have kind of been dominated by, I think there's stat 15 of the companies in the S&P 500 accounted for 97% of the returns in the past 3 years. So there are a lot of stocks that haven't moved. So I think that there's not a lot of depth in the market, in this market rally. So yeah, potentially it's an opportunity to go in and look at some of those unloved stocks. But yeah, there's certainly sectors. So go and look at what our analysts have to say around sectors that they think are interesting. This is funny. I have to read this one just because my mother will probably watch this. Dude, don't look at me that way. Many people wish for a good son like you managing your mother's money. I'm only doing this because I don't want her to have to move in with me. So this is really just self-preservation. I figure if she runs out of money, she's going to show up and be sleeping in our second bedroom, which is where I keep all my clothes. So yeah, this is just self-preservation. But thank you for that comment. All right, so let's see. What else do we have on here? Oh. Yeah. Okay. So we've got a question from Joel saying, where do you think the U.S. dollar is heading against other currencies? Is a gold ETF emerging markets a good place to invest if the S&P ASX looking overvalued and speculative? Okay. So a couple things on here. So once again, I obviously can't make recommendations. What I will say is, if you listen to that podcast I told you to, listen to all the Investing Compass ones, please, first. But if you listen to that Invest Like the Best podcast with Jeremy Grantham, emerging markets is where he sees value. So that's certainly his viewpoint. Once again, that is just his opinion. It is I'm certainly not telling you to do anything, but yeah, that's where he sees a lot of value, is emerging markets. If you go and look at, so once again, I'll go back to our website or my email or wherever I end up going. All right, if you look at our sort of monitor market section, so this is where you can see where we think from an equal weighted basis different markets are. So here's Australia, 1.08, means we think it's 8% overvalued. You can go look at every other country where we cover shares. So we think the U.S. is pretty overvalued. If you go to Europe, there's some interesting things that we still think are undervalued. So yeah, I look at different markets around the world. We're talking kind of holistically here, and particularly sort of focusing on Australia and the U.S. But yeah, at least Jeremy Grantham certainly thinks that emerging markets are a place to be. Look at you, Will. Will just put up the podcast. Stop promoting a different podcast, Will.
I'll put Alan's first.
Okay, good. So listen to that Jeremy Grantham episode. It is really interesting. And email me, and I can send you the link as well. So I can't really answer questions about gold or currencies. I look at the U.S. dollar a lot, given that you can probably tell that I'm half American. Is that what I can say now? Half American? Yeah, I don't know. Dual citizen, but I've still got some money in the U.S., so I look at the U.S. dollar a lot. But yeah, currencies are very hard to predict. Let's see, what else do we have? All right, we've got a couple questions on gold. Gold. I certainly don't have an opinion anyone wants to hear about on gold. But yeah, people use gold certainly to retain value, particularly if inflation takes off. But yeah, something to look at. All right, I think we're going to end this. Does that sound good? All right. Well, thank you guys. Thank you guys for joining. So we'll go back on Tuesday and we'll look at some of these different bear markets that came out of other periods where the market was overvalued. Of course, in hindsight, everything seems obvious. It wasn't so obvious during those times. But if anyone has any other questions, please send them through to mark.lamonica1@morningstar.com. All right. Thank you, guys.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.